When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about 5 key investing impacts of the U.S. trade war. We'll answer listener questions, and then finally, we'll discuss annuities. Do you really need guaranteed income in retirement? And if you do, is the annuity the right product for you? My name's Jeff Shade, and I'm just here to ask the questions, but the words of wisdom, solid advice, of course, come from the other Jeff in this radio program, Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. How are you doing?
I'm doing great, thank you. And of course, I hope everybody listening to us having a great weekend. We're glad you could join us here each and every weekend for Premier Retirement. Well, Jeff, as of the end of April here, the beginning of May, as this program airs, the U.S., of course, is engaged in an active trade war with China, to a little lesser extent with Canada and Mexico. So can you talk a little bit about some key developments here? And then I want to talk a little bit more about how investors can use this information and how we may want to change our investment strategy.
Well, we've been kind of in a stagflation state of economy for a couple of years anyway. The market's been overvalued for a couple of years, actually 30 or more months. It's getting to this point where, the yield curve's been inverted, it uninverted recently. Those are usually precursors of a recession. We've got overvalued stock market. Big time overvalued. Some people think can continue to go. So there's been some things that are really kind of rocky in the standpoint of what looks like economic woes ahead anyway. And now we got this tariff war kind of exacerbating the problem. I think the market needed to correct anyway. I've had clients say, why did Trump have to do these tariffs anyway? It's screwing up the market. And I said, well, the market's been overvalued for 2 years or more. It's going to correct anyway. It just needs a reason, and this is the reason. Well, what do you mean? It could stay overvalued forever if it could. Well, not in any real world. It's never done that before. It gets overvalued and it gets back to real value, and that's been doing that for 100 years. It's called economic and market cycles. They typically happen a little faster, and we've been pushing this one along long enough to where people are getting complacent and think, we can have an overvalued stock market forever and it could keep going up, and no matter what you do, you put the money in. But that's just not the way markets work. There's bear markets and bull markets and corrections and crashes. And those things are going to happen. They just sometimes need an excuse, or at least the news makers need some reason that they can blame it on. And of course, the left really wants to blame it on Trump and make it look like he's just an idiot and these tariffs are killing everything. I think the tariffs are going to end up having a long-term benefit to the U.S. It's going to create a more fair playing field for U.S. Trade deficit that's been extremely exacerbated recently because of all these tariffs. Everybody's trying to hurry up and buy stuff from foreigners before the tariffs actually kick in full gear and start costing extra money. Now, the tariffs, 145% on Chinese tariffs. I know that, does China pay them? Do the consumers here pay them? I think there's a little bit of both. Everybody kind of shares in those costs based on the fact that the U.S. wants to consume and China wants to sell stuff. So there's going to probably end up some sort of a compromise on whether these tariffs remain at 145%. Who pays them is probably the biggest issue, isn't the fact that there's a tariff of 145%. Somebody's going to get that money. Our government's going to win a little bit because they might be able to lower taxes on, individuals, corporations, and other things that generate economic growth in our country. But it remains to be seen that the U.S.-China trade war is probably the biggest one, especially since we get so many things out of China, especially since, as I said on our last show, you got the two biggest countries, one the biggest producer and one the biggest consumer, and two presidents that have big egos. And, they both are megalomaniacs, and they're used to winning, and they're used to, imposing their will and their power on each other and everybody. Chinese have wanted to be the dominant power for a long, long time. We've been the dominant power pretty much since we become a country, and we have a lot to win and a lot to lose by these trade wars. So hopefully it'll work out. And we'll kind of avoid this thing that's been the stagflation that we've been in for, I think, the last couple of years at least. It's been really not really a whole lot of economic growth. There's been a kind of a faked out market that makes everybody think things are okay, at least if you have a big 401k or have a lot of extra money in the market. It feels like things are good because you can still afford things. But the general public, 50% of the country that doesn't even own stocks, are the ones that are hurting. And, I hope whatever happens, we work through this issue. The fact is that the global trade flows are impacted. The supply chain was all interrupted because of COVID. We've got things that could happen very similarly with this trade war. If China wants to turn boats around and say, sorry, you don't get our stuff. I don't think China is that worried about the economic impact of the majority of their people who are already super poor and the elite who already have enough money to withstand this turn of events that, hopefully will work out in China. In America, however, we've always wanted to take care of everybody from top to bottom. That's why we put people on welfare, and that's why we take money in the form of taxes from the rich and give to the poor and try to make everybody okay. So we don't want our economy to suffer. I think we care a little bit more about it. Maybe we'll be the first to finally make some concessions as far as a compromise goes. I don't know. But I think the track that we're on from the standpoint that a businessman is in control of our government and our country right now, doing business deals that will benefit us on a business level, it may take a little while for the politics of all of it to settle down and for us to understand the wisdom in the goals and the strategies that Trump's trying to implement here. So I have great hope, just like I had hope that the economy and everything would work out great under Biden. I wasn't really thrilled with his mental capacity and his divisiveness and a lot of other things that happened, but I still root for the president, and I wish the other side could do the same for our president now. I'm rooting for him. I'm rooting for the strategies that he believes will get us into a better place. I know he has a lot more business acumen than I do. He has a lot more business experience in the real world, importing, exporting, trade deals, paying tariffs, and things like that. I mean, he's been in the midst of it just due to his own business ventures. So, Elon Musk too. I mean, those guys know about what's going on and more in the front line of how to fix it than I am, or even a lot of politicians that have never even been to an econ class, let alone run a business, that are back in Washington, yelling about the situation because maybe they're not able to manipulate the market anymore, insider trade as much anymore, make money at will anymore, set up non-government organizations that they can get paid through and money launder taxpayers' money to their own interest anymore. Hopefully all that stuff will come to an end and we can start off on a better footing. But yeah, these trade wars are definitely something that will impact our economy, will impact people for a while. But in the end, I think they'll come out better. I know that there was trade wars many times. In fact, I think part of that was to blame for the Great Depression. We emerged victorious several years later. After that, then there was some more trade wars and tariffs and all kinds of things after World War II that made things difficult from a standpoint of importing and exporting and economic growth for a minute. But again, sometimes we have to take a step backwards, just hurt a little bit in order to heal in the long run. Like I like the explanation that Trump uses, like you go in for surgery, you don't just walk out totally healthy. You got to recover. You got to kind of get over the deal. They're doing some surgery here. And hopefully the long run, it'll be better. You may not have needed the surgery quite this early, but it was preventative of something that would have probably killed the economy and killed America as we know it if we didn't do something about it sooner, just like an operation that could, extend your life. Sometimes we need to do those things that might be hard and might set us back a little bit and take a little bit of recovery and effort and rehab. So I think the country's going to go through some rehab as we sort all this mess out. But I do see all the money that's been committed to come to the U.S., to build cars, to build goods that are manufactured in other countries, goods that used to be manufactured here that are no longer manufactured here, returning because the tariffs are making it smarter for these companies to come back. I thought it was interesting. Saw a Mercedes commercial the other night, and it was, about how so much of Mercedes parts are actually being built in America. Well, gee, guess what? Well, I guess we can buy a Mercedes and we don't have to worry about that 25 or 30% extra tariff if we were importing everything directly from Germany anymore. Well, I guess they're ahead of the game because they're already doing some manufacturing here. But guess what? I'll bet they increase some of the stuff that they manufacture here just because, it's already enough to spend $100,000 or more for a nice car. I mean, nobody wants to spend twice that if they can get it cheaper. And Mercedes would love the market here to continue to buy Mercedes. So they're going to continue to build them here. And I'm not just talking about expensive products. We're talking about everything from the smallest and cheapest Toyota to more expensive cars. I don't know what else is going to move here, but I know that as we work out a more fair trade balance with these other countries, more and more countries will want to bring manufacturing here, kind of give back what they've taken from us. I don't know that it's going to make those other countries less prosperous. I hope it doesn't, because I know that a lot of the things that we've done by giving away a lot of our manufacturing to those other countries has created labor. But at the same time, I mean, if it's sweatshops and labor that's keeping everybody in poverty, is that really a better thing or not? I think the world will probably be a better place in the long run if Trump's agenda gets passed the way that he wants to. It just depends on how willing the rest of the world is to work with him, to trade with us, to make things fair, to benefit. And I think as America continues to be a little bit more let's fix the home base here, we'll be in a better position to even consume more. And a lot of those other countries are going to benefit as well in the long run. It may feel tough to them right away, and they might feel that there's a lot of trade tensions, especially with our neighbors, Canada, Mexico, not just China, but all our European allies that felt like we were dealing on a friendly basis and might think we're a little bit more adversarial now. But I think all in all, it'll work out. I always have great hopes and a lot of optimism for America, the American dream, and what we can accomplish here. And I think we have a leader that has a business background that can lead us to better economics long term. And that's what I'm hoping happens. I'm kind of sitting back watching like everybody else. I have my own theories. I'd like to be in the camp of Trump and be a cheerleader for what he's trying to accomplish rather than a naysayer and join the opposition and be divisive like so many people are. So I'm going to cheerlead as long as it looks like there's still hope and still light at the end of the tunnel. I still think we're there.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about the trade war that's going on right now between the U.S. and China, lesser extent Canada and Mexico, and how it may impact you as an investor. If you're worried about the trade war, if you're worried about where you're invested and how the trade war may affect you insofar as your investments go, give us a call here at Premier Retirement and request a complimentary meeting with Jeff on a one-on-one basis to talk about this. Our phone number, 520-780-9059. Make that call right now if you want. 520-780-9059. Again, there's no cost, no obligation for this whatsoever. Just a casual conversation between you and Jeff to get your questions answered about the trade war or anything that has to do with your retirement portfolio. If you do not have a retirement portfolio, you're getting ready to retire, maybe you've been doing it yourself, you want to have a second set of eyes on this, so maybe you can correct some mistakes and get started on the right path. Again, Jeff's happy to talk to you about that too. 520-780-9059. We're also online at premret.com, premret.com. Okay, Jeff, let's get back to our conversation right now. Considering the trade war and all the questions that people may have about their portfolios, how are you dealing with people's investments in their portfolio in the midst of this trade war?
Well, as I mentioned several times, we've been somewhat cautious coming into just these changing times of this market. I think we're going to see more volatility. We did see some volatility in the last couple of years, just on temporary basis. There were some shifts and maybe some momentum changes and some, market direction changes for a month here, a month there. I mean, we're seeing changes in market volatility, market direction like 3 times a day. I mean, it's crazy, the stuff that we're seeing. So either you have to be a set it and forget it and not worry about it kind of a person with a long-term approach, or, if you are worried about the market and the impact that volatility does to your mental well-being, you probably got to stay out or use index products and things like that have floors or at least some sort of a guarantee against principal losses through principal protected products. So those are still working well as far as the standpoint of not losing money. I've had a lot of just recent reviews when the market's down 5 to 10% or more over the last few months. People are like, oh, how's my other stuff doing? Well, hey, you know what? A few months ago, you put this money aside and went up for a minute and it's down for a minute, but it's not below where you started, or the money that you put in a few years ago locked in a nice gain last year, and that can't be lost. So there is some peace of mind with some of the ways that we're investing. And I mentioned that before, that as long as you have the money that you need to live on or the money that you need to create that peace of mind in a place that doesn't go backwards, that's a good start. The other thing is, how much risk are you willing to take? What could this trade war actually mean? There's a big sell-off and people just get a little bit tired and they capitulate, which is basically when everybody like Chicken Little runs because they think the sky is falling, they bail out of the market. And a lot of that's already happened from the standpoint of institutional investing, and people like Warren Buffett and smart people, they've already taken a lot of money off the table because they expect more of a crash. Does that mean all stocks are going to go down? I think if you're in the indexes, you're going to do what the indexes do, but does it mean that there's not opportunities to make money in certain sectors? Well, not necessarily. I mean, there's some sectors that have been beat up pretty bad that are great opportunities, and they are more of I wouldn't say a timing play, but more of a cyclical play, that when certain things get bad, certain other things get good. For example, gold and silver, precious metals do well when the dollar is weak. The dollar's been weakening mostly for the last 2 years, kind of routinely, especially in the last few months. People are a little bit scared to invest in the dollar. They're not sure about how the tariffs are going to impact things in the U.S. And we're seeing some strength actually in Europe and other foreign countries, international stocks, because a lot of that money is actually staying in their own countries instead of chasing the market here. There are some opportunities to still gather or take advantage of some upside if you're smart about it. Our managed portfolios strive to do that. Did pretty well last year, done okay managing risk so far this year. But again, it needs to be according to somebody's risk tolerance, whether you want to go into those things. Like the energy market still holding up pretty well. The utilities market's holding up pretty well. If you're buying just gas and oil, that's going down. But utility type of energy companies aren't doing bad because everybody still needs to heat and cool their house. They're still spending money on the basic necessities. So those tend to be a little bit more stable during times like this. You still got some growth industries. Something that I found is, and I'm just throwing some ideas out. I'm not making any stock recommendations here, but there's like home education. A lot of people are homeschooling their kids and taking a little bit more proactive approach in that. Just some things that I've noticed lately in that regard are nice and solid. You've got grocery stores, even Walmart and Costco, although they softened up recently, are looking like they're solid at creating some what we call market resistance, or they're resistant to the market fluctuations a little bit more than other stocks. So if you do want to play in the stock market, be smart about it. I think it's a stock picker's world in the next year or so, or at least an industry stock or an ETF type stock picker's world. The stock market, if you want to ride the indexes, are going to be all over the place. And I think eventually you're going to settle down a lot lower than they are right now. That's my take on it. And that's the take of a lot of people smarter than me. So, I'm not just making that up by myself. I'm looking at people that have been in the investment world decades longer than I have, including Warren Buffett, Jamie Dimon, who thinks there's just going to be some impacts based on higher interest rates and weak dollars and just other things that are happening. Ray Dalio, he thinks we could be on the verge, and it might even be spurred on by this tariff war if it doesn't get settled soon, that there'll be a credit crisis and there'll be a meltdown and there'll be a repricing of debt. I hope it doesn't get to that level, but we talked about that a little bit briefly last program. And he's a smart dude. The guy manages more money in a hedge fund than I think anybody else does. He's certainly somebody to look to and take advice from. So again, all these little things that are happening, I think, are more of an excuse. They do definitely impact money flows to and from countries. They impact profits on businesses. And until they get sorted out, they will definitely have some market implications, including volatility. So if you can't stomach volatility, go into low risk, just nice, easy going short-term bonds, money markets, things like that, and don't lose money. In fact, if you look at about 3 years ago in 2022, when the stock market, crashed, right at the end of 2021, it pretty much was peaked. If you look at that growth from that period of time to just right now, you're looking at about a 12 or 13% gross rate of return, because we had a big downturn, then an upturn for a couple of years mostly. We had a couple of hiccups along the way, little corrections, and then we've had this recent downturn in the market. But if you're looking at the overall impact of this roller coaster ride on your investments, if you paid fees, you probably could have done better sitting in a money market or a CD for that same period of time than riding the roller coaster in the market. Now, does that mean long-term the market's not going to do well? No, but I still think the market has some downside potential, whereas CDs and money market don't. So looking back, you might think, well, gee, Jeff, you missed the upside of the market. Well, yeah, but on most of our money, we didn't get any of the downside along the way either. So in the end, we have more peace of mind, better gut health than some people, and about the same portfolio value. In fact, if you look at bonds, the bond values over the last 2.5 years are still down 20% or so. You could look at just the aggregate bond market, and it peaked out. If we look at where it peaked out about 3 years ago, it's like 120. That was the price. Right now, it's barely 99. So, that's lost about 20%, still down. So if you've been waiting on bonds to come back, you're still losing on the bond portfolio. If you had a stock and bond portfolio, you're probably somewhere around break even at this point. That's been the last couple of years. Do you think the next few years are going to be better? Well, I think some of the things that we're seeing on the horizon as far as trying to fix the trade imbalances and economic woes that we've been going through, it may be a little worse than that over the next 3 years. So I think people need to take caution. Don't risk money you can't afford to lose. And for heaven's sakes, if you're living on your money and taking income, don't have that money in the stock market. Don't have it on the roller coaster. I wouldn't even have it in bonds, even though they're beaten up. I don't know that bonds are definitely going to go back up because interest rates are going to go back down to 1 or 2%. I don't think they're going to go down to 1 or 2%. I hope they go down a little bit. I would love it if they went down to 1 or 2% from the standpoint of being easy to borrow money and what it does to the economy. But that's not healthy either, to having 1 or 2% interest rates, because then savers can't make money and they have no choice but to risk money. Another thing, some of the things that's got us into this position that we're in right now, where it's kind of uncertain and nobody really knows what to do with their money, and they're scared that they're going to lose. They're even more scared that they're going to miss out on the next big upswing in the stock market. But it doesn't always just go up. There's times when it goes back and forth and it goes up and down, it seesaws and whipsaws and does all kinds of things for sometimes even a decade, like it did between 2000 and 2010. The S&P was actually at zero total return over that period of time. So if you wanted to ride that roller coaster and you were using money, you were losing money because you were locking losses, because that money was down below where it started. And if you're at a point where you have enough to retire on or you have enough to live on, take that money off the table and live on it, and only risk and let ride the money that you can afford to risk and let go and not touch. I know that's not really conventional wisdom if all you listen to is Wall Street hype and cheerleading from money news organizations and the Jim Cramers and all these people that are pontificating on TV about how great the market is and how you should just leave the money in there. Well, if you can leave the money in there, great. But most people build assets for retirement because they want to use them and spend them, not because they want to just ride them out long term. That's a whole different game, but that seems to be what the market is built for, and that's all they promote. It does not work with income, and it does not work with retirement planning if you're taking income and living on those dollars. So again, you have to rethink what's happening. You have to rethink your positions in the market. I think safety is always a better choice when it comes to your retirement dollars than it does your growth dollars. If you're 20 or 30 years old, you're in a whole different position than most of the people listening to this radio show, I'm guessing, who are more closer to retirement. I mean, after all, this is the premier retirement show, not the premier, hey, let's retire in 40 years show. So, I try to focus on the advice that goes more along with the lines of those people who I believe are listening. That doesn't mean I don't believe in the long-term growth aspects of the market. I know that it's a great investment tool to build wealth. It doesn't mean any of those things. It just means there is a time that you need to be more careful than just set it and forget it and just hold and hope and let's see what the market does. And I might be able to live 30 years in retirement. I won't. Well, we'll just see what happens. I mean, that doesn't sound like a plan to me. That sounds scary. And honestly, if I'm the one in charge of your money, that sounds scary to me. And I'm not going to lose sleep over your money. I'm certainly going to try to help you not lose sleep over your money, but please don't make me lose sleep over it by putting you in more risk that I can stomach. I'm a safe money guy first. Let's protect what you've worked a lifetime to achieve. Let's not just keep doing what you're doing and keep losing money. I can't believe how many people I meet that come in and say, well, I'm really worried about where it's at, but really scared to put it in something safe because then I'll miss out. Like, miss out on what? Take advantage of the blessings that you've been given by a good market. In fact, an overvalued market where you can take profits that really shouldn't have been there, in my opinion. Not yet, but the fact is they are. Take profits. You never get hurt taking a profit. Leave the market in and give it back. And then you say, oh, well, I got to wait till it gets back to even before I can get out again. Well, during the 2010 era, it was like 5 or 7 years before the market got back to its peak before it crashed both times. In 2000, it took 7 years. And in 2008, when that crashed, it took another 6.5 years. So you want to wait that long before you can use any of your money or before you should use any of your money, because everything you use, if it's down, is going to lock in that prior loss. So if you're down a little bit, lock in that prior loss, but it's not really a loss, is it? Because you put in a lot less money than you could have right now if you take those profits off the table. You're always taking a profit, even if you're not taking it out on the peak. Nobody can time the peak, but you can make responsible decisions about your money, and that's really what we're trying to focus on here.
Our show is called Premier Retirement. We're talking with Jeff Hogan, founder and president of Premier Retirement Planning in Tucson and Mesa. We've been talking about the current trade war situation, how it may impact you in your investments and your portfolio. If you have questions of Jeff, not only about the trade war, but really anything that has to do with your retirement portfolio, maybe you've been DIYing it yourself, and maybe you want to see what a pro would think about what you've done, give us a call here at Premier Retirement and set up an appointment with Jeff. No cost, no obligation for this, just a casual conversation. 520-780-9059. You can also find out more about us online at premret.com. Hey, Jeff, time for a break. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059. or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for joining us here each and every Saturday for Premier Retirement on 790 KNST, where Tucson comes to talk. We're on the air for you 4 times a week, Saturdays at 7 a.m., also 9 a.m. and 1 p.m. If you've missed us on Saturdays, maybe Sunday's a better time for you. We're on Sundays at 11 a.m. And of course, we're on the air for you on your schedule 24/7, 365 days a year, wherever you get your podcasts. Search for Premier Retirement with Jeff Hogan. You'll find this show and, boy, a whole bunch of other podcasts so you can stay on top of your journey towards a confident retirement. Once again, our telephone number, 520-780-9059. If you hear anything today that piques your interest, call that number to set up a conversation with Jeff. No cost, no obligation. 520-780-9059. You can make that call today. Leave your name and telephone number, and Shelley will get back to you. Okay, Jeff, time for listener questions like we do every week. Bill's listening to us in Tucson, and Bill says, I have about $500,000 in a 403B account. I'm writing my will, and I don't know whether the money in my 403B will be subject to taxes when it's distributed to those I list in my will, or will the money just pass directly to whom I've named?
Well, a 403B is just another qualified plan like an IRA. 401k is another qualified plan. Qualified plans meaning that they are not taxed. It's in fact another word for 403B is a TSA or tax sheltered annuity. It's really a retirement annuity that typically you buy through a school employer if you were in the education business or even in the healthcare business. A lot of nurses and healthcare people also have those. So they're treated just like a regular IRA. They go directly to whoever you put on as a beneficiary. They go direct to that person. Whoever gets the money pays taxes on it. You will pay taxes on it as you withdraw it. You still have the same withdrawal rules as you would an IRA. So currently it's at age 73. If you were to be 73 years old this year, you'd have to start taking required minimum distributions from it. You can roll a 403B over to a self-directed IRA. You still have the same impact as far as taxes go. You don't have to pay taxes when you roll that money to an IRA, but you can self-direct it and put it in things that may not be available with the 403B. I find sometimes 403Bs are limited to just some really anemic type of an investment opportunity that either pays a guaranteed rate of 2 or 3% forever, or it might be even a variable type account that has a lot of fees in it that you don't even know about unless you read all 800 pages of the disclaimers and prospectuses and things like that, if it's a variable type of an account. But typically, they don't offer a whole lot of options as far as how to invest. So most of my clients, if I see 403Bs, we look at where can we move it to a better place. And there's no tax ramifications in moving it. You just move it from one qualified plan to another, and then you can manage it as it goes. You set it up with a beneficiary. You don't have to list it in your will. In fact, I don't think anybody should use a will. A will is really just a court document that makes things go through probate. If you put a beneficiary on all your assets, it goes directly to that heir without probate. So keep the lawyers and the courts out of your estate. Don't pay them money to do what your kids can do themselves, and that is just fill out a claim form and get their share of the money. In fact, you can put 2 or 3 children, or even people that aren't your children. Anybody who you've named can be listed on the beneficiary designation itself. So don't get caught up in this will thing. Wills are a waste of money, waste of time, and a waste of your assets when you die, in my opinion. I might have some lawyers dispute that. I have no idea how they'd come up with a case that would be relevant in my opinion. However, just because I've seen what I've seen, I'm a certified estate planner. That doesn't mean I'm a lawyer. It just means I understand how estate planning works. And I understand how beneficiaries work. I understand how trusts work. I understand how wills work. And I understand how to make sure my clients' assets remain in the family with the least amount of trouble passing on when you pass, and with the least amount of taxes when you pass, and can strategize how to make those things go to your heirs the most efficient. So I say this from experience. That's a big part of what we do. We don't disclaim tax planning. We don't disclaim estate planning. We don't disclaim any of those things that go along with financial planning, like so many people in this industry do. So many companies say, oh, we don't give that stuff. Go to your accountant, no lawyer, figure it out. Just let us manage your portfolio and collect our fees. We'll make money on your money, and you worry about all the other stuff. I think a comprehensive planner, somebody who calls himself a fiduciary, ought to take care of all those things, not just manage your money and disclaiming all the rest. So again, a will doesn't do a whole lot, in my opinion, other than take care of those things you might have forgotten to put a beneficiary on, forgot to speak about, or if for some reason there's some contest about an asset that doesn't have a beneficiary and owner when you die, that has to go through that will or that estate process. Hopefully you've taken care of matters and you have an advisor that can make sure that you don't need that will and that everything can go exactly like you said, directly to who you've named.
Bill, we appreciate you listening to us in Tucson. And of course, we will send you out Jeff's book, Retirement, The Road Ahead. If you have further questions, Bill, 520-780-9059 is our telephone number. Don't hesitate to call that this weekend. Request an appointment with Jeff. No cost and no obligation. Jeff, our next question is Chuck in Sahuarita. You and I have had a little debate about how to pronounce that. I was looking up online. Tucson.com says that Sahuarita is derivative of the Spanish word suaro, which means little suaro, I guess a little cactus. But it says it's Sahuarita, but it's Sahuarita, is it not?
Well, I don't know. I would say if I speak Spanish, I can actually roll my R's. I say suarita, that's kind of how they would say it. But if you do that in a restaurant, they'll start talking Spanish to you, order your tacos in English and make sure you don't say suarita or you won't know how to pay your bill or what the heck you're getting with your guacamole. So,
yeah,
be careful.
Well, anyway, I'm going to go ahead and continue to call it suarita unless somebody calls and tells us.
Yeah, I think that works.
Yeah, until somebody says that's not what it is. Apparently a lot of little cacti in Swarita. I'll have to go see. Anyway, Chuck says the bulk of my money, around $300,000, is in a Fidelity account invested in a target date retirement fund pegged to 2025. I'm about 2 years away from when I had hoped to retire completely. I have 2 other smaller investments, and I'll also receive a small pension. I thought about moving the Fidelity fund into a cash-type fund, but that ship has sailed. I decided to follow the usual advice and hold steady. I'm literally afraid to look at my balance. I have no idea at this point how much I have. Do you think there's a chance that this fund will ever recover?
Well, yeah, I don't know how much time you have. I think 2 years might be a push to try to make a recovery by then. But what I really don't like about these target date funds is they don't allow you to use your own brain about how your money's invested. When you see interest rates being driven up by the Fed over and over again for a few years, like they were since 2022, you know that bonds are going down. Now, I don't mind Fidelity. I don't like target funds. Fidelity's great. We use them for all of our custodian, well, not all of it, but most of our custodian for most of our managed money. So I have no qualms with Fidelity. What I have a qualm with is those target date funds, and I don't care whether it's Fidelity, Vanguard, or any company. They're typically just parked in probably a half or more bonds in a 2025 retirement target date fund, and probably about half in stock. So the 20% that bonds lost are still basically lost in that fund. Well, if you're going to retire, I mean, you can't afford losses. Why in the world would you have things that could go down? But, you know, if you see that happening and you're actually managing or have somebody looking after your 401k investments, you'd have been way better off just being in a cash fund as a target date fund instead with no risk. Because if you're going to retire in 2025 and it was 2023 or 24 when you bought that, why would anybody put anything that could have risk if you can't afford to risk the $300,000? You shouldn't have been in the market or bonds. The stock market, looking back, has gone up maybe 15 or so percent since the market started taking a dump. Same time the bonds did. So you're probably still break even or down from even a few years ago. And lately, because bonds haven't recovered and then the stock market's gone down 10 or 15 since it peaked out into this year, you're basically not looking at it. Now, if you say the ship has sailed for putting your bulk of your money in cash, I think that's wrong. That's like saying the market already crashed and it's not going to go down anymore and it's going to recover. Well, will it? I don't know. I don't have a crystal ball. I never profess to, but I do have assets that you could move that 300,000 or whatever it's worth to. And if the market does continue to go down, you don't lose any more money. If the market goes up, you make money. So why not have the best of both worlds? You can get out. And by the way, those indexes that we use in these principal protected accounts I'm talking about have also come down. So you're actually buying in low. So you're selling at a small loss, but you're buying in the other account low, but it doesn't go down lower. It really baffles me why people don't see the benefit of that. I just want to wait till it recovers. Well, if the market's down 15 right now, and the big crashes of the last couple of decades have been around 50%, and if we think the market is overvalued by about as much as it should require a correction of about 50% to get back to normal value. And most corrections end up at normal value eventually. Now, this one's taking a little longer than most. That doesn't mean they can keep being, the stock market can't be, well, I can't say it can't. It never has remained overvalued for the long term or permanently overvalued. Well, why can't it just stay overvalued? I've had people ask me. I don't know. It could. It just never has. I mean, history says it won't. And so let's just go by what we know and the fact that history repeats. The market will find a reason to correct, whether it's tariffs, whether it's a president nobody likes, or whether it's just the fact that banks decide to sell all their stock and banks can't loan money and housing falls and they use that as an excuse. Whatever it is, there's going to be an excuse. Most politicians will just blame the other party and that'll be the excuse. The fact is we're in a cycle that is going to correct. And if you don't want to lose more money or take a chance on it, take what you have, be happy, and don't worry about looking at it. If you are scared to look at the market, that means it is scared money. Scared money is money you can't afford to lose and should not be in the market. So if it's in the market and you're scared about it, then you shouldn't be in the market. That's my opinion, period. Yeah, the conventional wisdom, well, I'll take the conventional wisdom and just leave it in the, you know what the conventional wisdom is? Wall Street that doesn't want you to take it out of Wall Street. It's Wall Street that's self-serving and only cares about making fees on your money as long as they can and saying, oh, well, in the long haul, it comes back. Well, okay, there's a little bit of truth to that. But it doesn't come back if you retire next year and need to use that money. That money will not come back. And I've said this as an analogy before. It's like you have a chicken that lays eggs, but you decide to eat the chicken. Well, you're not going to get any more eggs.
Right.
You know, if you can live on eggs and you don't kill the chicken, you can live on eggs. You know, maybe that's why you can live on just the dividends or the interest that portfolio generates. But guess what? When the values go down, sometimes the dividends and the interest goes down as well. So that's not always the best take either. If you want to use that 300 and make the maximum of it and maximize it for income in retirement, you ought to look at other options that are built for income in retirement. Not the stock market. The stock market is not built for income in retirement. It is built for long-term holding and hoping and having enough time to wait out market corrections, crashes, economic cycles, and the like. It's typically a 10 or more year proposition where it makes sense to have most of your money in the market. The thing is now we've learned that bonds don't just go up either. We've been in a 40-year bond bull market. That's because interest rates have basically been falling since, the early 1980s, and they bottomed out a few years ago. They really had nowhere else to go. They were almost at zero. So now that they're back up around 5%, which is still a far cry from the 10 to 20% they were back in the early 80s, when interest rates go up, the bond prices go down. So if you hold bonds and you have to sell the bond to live on, you're locking in losses again. So target date retirement funds, I think, is a gimmick that allows mutual fund companies like Vanguard, Fidelity, Hero Price, and others to basically let their new managers cut their teeth on somehow how to build a static portfolio and watch the market and be in charge of something that isn't well managed, but maybe give somebody a little bit of experience in trying to put together a portfolio and hopefully learn something. If they rise to the occasion and do well, maybe they can move on to bigger and better things. I really don't know, other than the fact that they want to offer something that sounds really cool, that's you don't have to manage, that's just parked in this asset allocation that's never managed or changed. I don't understand why you'd pay a fee for that, but people do. People do all day long. I don't know. I think it's mismanagement of money, and I think it's bad information. It's too bad 401k companies don't offer things that are more geared to retirement, like things that could be like a personal pension plan where you could actually invest your money in something that would generate guaranteed income with a guaranteed amount, like a typical pension, where you have a defined benefit, not a defined contribution. We know how much you can put in. We just don't know how much it's going to be worth when you take it out. Well, what if you could know what it was worth when you take it out? They don't have anything in 401ks that do that anymore. Or I don't know if they ever did. So why don't they add that? I don't know. The only way you can add that is look for it yourself. That's what we offer. We offer those guaranteed income plans that 401ks don't. We do it in the form of IRAs, and we do it with predictability, guaranteed income, peace of mind, and the things that you just don't get from a 401k and even a target date retirement fund. So there's a lot more out there to look at. Unfortunately, you haven't been exposed to it at Fidelity. Like I say, we hold all our managed accounts there. Well, we have tons of other tools in the bag that we use that aren't at Fidelity, that are at other companies. So if you want to explore, be enlightened as to what the world actually offers for retirement, way better, in my opinion, than a target date retirement fund. We'd love to have you come see us, and we can walk down that road together and explore together.
Chuck, appreciate you listening to us in Swarita. And again, our telephone number, 520-780-9059. If you'd like to come in and sit down and talk with Jeff, we'd love to talk target date funds and anything that relates to your retirement portfolio. No cost, no obligation. Jeff, let's move on now to Cynthia listening to us in Marana. And Cynthia says, I'm a healthy, active 69-year-old with $370,000 in equities, but I'm nervous that stocks are overvalued. My portfolio has no bonds. What's the best way to create a bucket strategy using index funds? By the way, I love to talk about money, so I love your show.
Well, thanks. I love to talk about money as well, and I'm glad you listened to the show. I think that 370 in equities, you're kind of in an index if you've got a diversified portfolio of equities, and you're talking about a bucket strategy using indexed funds. I don't know that there is a bucket strategy using index funds, because the indexes, if you're talking about S&P, Dow, Qs, NASDAQ, they're all going to go up and down together pretty much at the same time, depending on economic forces, buys and sells, and whether the institutions are selling or buying. And it's typically the big money that drives the markets. There's a lot of economic situations out there that are causing a lot of uncertainty in the market and causing a lot of volatility. There is a strategy I love that is a bucket strategy that uses indexes, but they're principal protected indexes. If you could backtest this particular account that I'm looking at, it uses different indexes that are actually indexes of indexes. What I mean is it might have S&P, it might have bonds, it might have other things in it. And if there's some volatility in the stock market, they might move to bonds automatically, and it does it for you. You don't have to time it. You don't have to do anything. There's an algorithm that makes those changes for you. It could be into foreign currency or commodities or different things that these indexes of indexes can move to. There is a new product with a laddered strategy. This is a principal protected account. It's an index annuity that has a laddered strategy. It's actually a laddered strategy of indexes. 20% of your money locks in every year. 20% pays more, but it locks in every 2 years. 20% locks in every 3 years, 4 years, and 5 years. So a 5-year strategy with 20% of your money in each term. Each longer term pays more, but they lock in systematically. If you backtest something like that, you're making well over 10% rate of return. And if you could have bought this product 10 years ago at today's prices, at today's interest rates, now you couldn't, but if you could just overlay this product on what the market's done in the last 10 years, it beats the market with no risk. So there are ways to index, of course, future returns don't have anything to do with past performance, but we really can't base anything except on how does it work in different markets. And all we can do is look at history in the past and to decide if this makes sense. So maybe it doesn't beat the market, but at least it doesn't lose money. If the market loses money, anything beats the market that doesn't lose money, right? So at least you've got that part taken care of. As far as the upside goes, you can index different indexes, and it doesn't have to be all in equities on some of your money. Now, I'm guessing that this 370 that you have in equities isn't money you plan to use all at once. Maybe you plan to use a couple thousand a month, or maybe $30,000 or $40,000 of that per year, maybe maximum while you're retired. And if that's the case, these annuities allow that much liquidity for use over time. Some annuities also guarantee you a guaranteed rate of return and a guaranteed rate of income if you choose to use that kind of an income strategy. So again, if you're at that point where you're trying to protect what you've gained because you're nervous about stocks being overvalued, and I agree with you, they are overvalued. Everybody knows they're overvalued. But, the people that are still investing in them and cheerleading the market are saying, yeah, but the market can stay overvalued for a long, long time. Well, I don't know about that. It hasn't in the past. It stayed overvalued for a long time, but not forever. And it always seems to correct. And I think if you look at history, we're overdue for that correction by about 6 months or so. Doesn't mean it's not going to ever happen just because we've beat the past 2-year length of time that it took in the longest waiting period before, or is 30 months, enough? Actually, we've started a correction at about that 30-month level area this year. And I don't think we're done with it yet. I know that there's a lot of people saying, oh, the market's over. We've already hit bottom. It's fixed. It's going up from now, and buy the dip. It's over. But there's always these buy the dip bounces, or we call bear market rallies. I think we're probably going to have some more of those. So if you want to lock in the gains that you've made already, not worry about downsides, take some of that off the table. Consider some of these other bucket strategies that I'm talking about. Using indexed funds doesn't have to be the stock market. Now, there are some you can strategize, and you can use the S&P, but they probably won't pay as much as some of these other indexes that are dynamic indexes of indexes, just because they don't have to be stuck in the S&P. If the S&P is whipsaws back and forth for the next 10 years, you won't make that much money in an S&P index as you would in an index that actually makes money if the market's going down. The other one only makes money. It doesn't lose money when the market's going down. It only makes money when the market's going up, and that's limited. So again, there's plenty of ways to skin the cat. There's plenty of ways to do bucket strategies. I like exploring outside of just the Wall Street model. And by the way, we can strategize and ladder a portfolio in a managed portfolio bucket as well, but you're going to have to deal with the risk. So if you're nervous about the stocks being overvalued, consider things without risk. If you're not nervous about things being overvalued and you just want to strategize, I'd say diversify out of just stock market indexes. And you might want to even look at FTSE or some foreign indexes that are holding up pretty well right now. So there's a lot of ways we can diversify into buckets of indexes if you want to do that, without being all in equities that are tied to the U.S. stock market.
Cynthia, we appreciate you listening to us in Moran. And of course, you're going to get Jeff's book as well, too, Retirement, the Road Ahead. And we do love to talk about money just like you, Cynthia. If you'd like to talk to us, 520-780-9059. It's 520-780-9059. And of course, you can always go to the website, find out more about us at premret.com, PREMRET.com. Jeff, not a lot of time left in our radio program today. I billboarded that we would talk about annuities. Do you really need guaranteed income in retirement? A survey found that in 2019 of asset managers, 42% of those managers believed that a retirement income solution needed guaranteed income, but here just last year, only 37% believed that to be true. So what about annuities? First of all, is that a good choice for guaranteed income these days? You're giving up liquidity, and there are also fees involved with those.
Well, there's fees involved with anything managed. There's fees involved with anything. I mean, if you buy a bunch of mutual fund, there's still fees. You can buy a bunch of ETFs and hope the market goes up, but you don't have anybody helping you, knowing when to trade them or buy and sell or looking at the markets for you. You've got fees on variable annuities, very high. I don't like variable annuities for income or for any reason, actually. Your Social Security is an annuity. It's not liquid either. You can't just cash it in, but it's set aside there, and it's going to create a base for your income for the rest of your life. Nobody seems to complain about Social Security. They'll complain more if it isn't there for them. I mean, everybody wants Social Security. They want that. They plan on it. Well, why not have, if Social Security is only going to pay you $30,000 a year, but you need $70,000 a year, why not put some of your savings away for a guarantee of that extra $40,000 a year that you need? So I think annuities are the exact tool that you use for creating your own retirement plan, especially if you don't have a pension or other things that are supplementing your Social Security. So don't be scared of the word annuity. You should have them to the extent that you need guaranteed income. The clients that are happiest in my retirement family here at Premier are the people that don't worry about how the next month's bills are getting paid. They love income. They love guaranteed income. And the fees on the annuities are no bigger than fees elsewhere if you really compare them, in my opinion. The other thing is how much would you pay for insurance on your mutual fund portfolio to guarantee against losses? Wouldn't you be happy to pay 1 or even 1.5% for that? I think you should. I think it's worth every penny to buy insurance on the downside. Also to buy longevity insurance, that if you're 90 years old and you ran out of money in the stock market because it crashed 2 or 3 times between the time you were 60 and 90, which it probably will, because every decade there's one and every couple of decades there's a few. So, you could run out of money before you run out of time with anything that's in the market, anything that's stocks, anything that's bonds. And why would you want to put your entire livelihood and retirement plan based on something that you can't control, something that you can't guarantee, something you can only guess at, and something that could change on a dime and really come up with a surprising bad year or even a bad decade, like the year 2000 to 2010. Nobody thought a whole decade could turn out to be a total return of 0, but it did. So I like the peace of mind that it creates. I like annuities. I do not, however, like the annuities that are offered through 401ks. Are typically very anemic. They're typically, hey, you give me $100,000 and we'll just pay you this, and they are not liquid at all. The kind of annuities we use in retirement plans are annuities that you can cash in if you decide to bail out and get the liquid money out, completely liquid after, say, 8, 10, or 12 years in most cases, or actually pretty much all cases on the ones we use. But you can always get a certain portion of that annuity account out without penalty. And the worst case is, if you did want to bail out of the whole thing, you might lose 10% roughly. I mean, most people, if they bailed out of this, if they bought stocks Christmas time and wanted to get out right now, they're going to lose more than 10% already. And, but they're liquid. Yeah, you still lose more money on it than something that is considered not liquid. So the kind of annuities we use are, in my opinion, liquid annuities. They're annuities where you still maintain control of the balance and the principal. The principal is guaranteed, and so is the income. So there's different ways to skin the cat, and there's some hybrid, new age, new generation annuities that work a lot better than the old annuities that give annuities a bad reputation. You just need to explore the options. And if you're in the retirement planning game, you should be an expert in annuities because it's really the tool that was invented for people in retirement. And I can't imagine somebody that's in the kind of the middle to lower middle class to upper middle class, even wealthy, love annuities that guarantee income. It doesn't really seem to matter the level of economic welfare somebody has. People like the guarantees and the peace of mind that it brings, generally speaking. Some don't, and that's okay. If you don't, we can still do our best by managing money and creating low risk accounts for income or no risk accounts for income that don't make very much, but they don't guarantee income, then hoping that the accounts at risk do okay in the next 5 or 10 years to replace that income when you've used up the low risk money for income. So different ways to skin the cat. I prefer annuities. I think they're awesome. And I think you should look outside of whatever the 401k offers because generally speaking, they're not that liquid. They don't perform that well, and they don't really create the benefit that most people want from an annuity.
So, Jeff, our listeners have questions about annuities or guaranteed sources of income. Again, we invite you to call us here at Premier Retirement. Request a casual conversation with Jeff. 520-780-9050 on our telephone number. You can make that call this weekend. Leave your name and number. Shelley will call you back during the week and set up that conversation. Again, this is just a casual conversation. It is not a sales pitch. You're going to ask the questions that you need the answers to about guaranteed sources of income so you can feel better about your retirement. 520-780-9059 or online at primred.com. Hey, Jeff, out of time for this week. Thank you so much for your time. Most importantly, though, I want to thank all of our fine listeners here in the greater Tucson area for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.